Lately, a lot of you have asked me what would happen to real estate investment trusts if we hit a recession, and today's video I'm going to answer that question. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and I'm about to explain to you why I think that a recession would actually be beneficial to REITs in today's unique environment. And I know that this sounds hard to believe because generally speaking, obviously recession is a bad thing. Typically stocks, including REITs, tend to even crash when we hit a recession because it leads to dropping demand for properties, less development opportunities, potentially dropping occupancy rates and rents as well. But context matters, and my reasoning here boils down to really three things. The first point is that most property sectors are quite recession resistant. I'm going to go through this shortly. Then secondly, today valuations are already heavily discounted. REITs have already crashed. And then thirdly, I think that the recession will bring lower interest rates, which will be highly positive for the REIT sector. So let's go through each of these points one by one, and you'll see shortly why I'm really not worried about a recession. And in fact, I think that it could be positive for the REIT sector and even lead to a recovery. But before I get into it, please let me know in the comment section below if you have any other questions about the REIT sector. I'm going to start producing regular videos like this one, answering your questions in a Q&A format. So if you have any questions about the REIT sector or even a specific REIT, please let them in the comment section below and I'll do my best to get back to you as soon as possible. And then secondly, if you like this type of content, please click the like button and subscribe to the channel. That helps me a lot to keep on growing. Thanks so much in advance. So the first point I want to make here is that most REITs are quite recession resistant. They earn steady and highly consistent and predictable cash flow from long-term leases with typically many years left on them, and therefore their cash flow really doesn't change materially in a recession. And on top of that, today most REITs use very little leverage. The average LTV in the REIT sector is just around 30%. Debt maturities are also quite long. They've really learned their lesson from the great financial crisis, and so they're today much more conservative with their balance sheet. And so here we can perhaps take an example. NNN REIT is a very popular REIT that comes to my mind. It owns net lease properties that are service oriented for the most part, like Dollar General dollar stores, Chevron gas stations, Taco Bell restaurants, CVS pharmacies, and so on. And these properties are under long-term triple net leases. They have over 10 years left on them on average, and so its cash flow is going to be highly consistent and predictable for years to come. Whether we go into a recession in 2024 or 2025, its cash flow doesn't change. In fact, it would even keep on increasing because its leases include automatic annual rent hikes of about 2%. The tenant is also responsible for all property expenses. The only scenario in which its rents would decline is if the tenant defaults on its lease. But in the case of NNN REIT and most other net lease REITs like Realty Income, the rent coverage ratio is about 3 times for net lease properties. And what this essentially means is that the tenant would need to see its profits drop to about 1/3 for it to not be able to cover its rent payments anymore. And that's very unlikely in a regular recession in which the GDP drops by a percentage or 2 or 3. The mild recession typically doesn't cause such a huge change in profits to the operator of a recession-resistant net lease property like a Taco Bell restaurant. So, I mean, even if we look at the pandemic now, which was arguably the worst possible recession for a net lease REIT like NNN REIT, most of its rents kept getting paid in full and on time. And in select cases where the tenants were not able to operate their properties, the rent payments came in a bit late, but they were then paid later. So this is really the ultimate proof that these are very recession-resistant businesses. Even the pandemic, which was an apocalyptic scenario for these REITs, couldn't derail their business model. They kept on growing their cash flow through that crisis, and so a mild recession wouldn't have any major impact either. I use here net lease REIT as an example, but this also applies to most other property sectors. Here you can think of, as an example, single family homes. If you're renting a house, you're probably not going to vacate it or stop paying your rent simply because we go through a mild recession. Same also applies to manufactured housing communities. You're probably not going to find anything cheaper anyways if we go into a recession. Apartment communities also, they are fairly recession resistant. Everybody needs a roof over their head. Farmland, everybody needs to eat. Service-oriented shopping centers such as those owned by Kite Realty or Whitestone REIT or Federal Realty Trust, Regency centers. We all need to eat. We need to go to a grocery store. We need essential services. We're still going to cut our hair. We're still going to go to the dental clinic, to the dry cleaner, and so on. These are, the demand may change a little bit in a recession, but really not that significantly that these tenants will stop paying their rent. And the tenants also, they also know that a recession is temporary, so they don't want to to lose these profitable assets because of a temporary crisis that causes their profits to decline a bit for a year or two. They are long-term oriented. What else could I use as an example here? Cell towers. We're not going to stop using our phones or data simply because we're going to recession. So REITs like American Tower, Crown Castle, SBA Communications will keep earning steady rent checks. Data centers, they will likely keep on growing through a recession. Industrial REITs. Industrial sector is a bit more cyclical, but even here, there is significant margin of safety because most industrial REITs today have leases that are deeply below market levels. And so because of that, they have good margin of safety, as the market rents might be, let's say, $30 per square foot, but they're currently charging only 15. I'm just making up numbers here, but this means that even if we go into recession, let's say the market rents drop a bit to 25, they're still below market. So there is some upside as leases expire, actually, even as we go into recession. The healthcare property sector, that might be the best example. Alexandria, as an example, owns life science buildings with 8 years left on them. They're also below market. They enjoy 3% annual rent escalations. These big biotech companies, they will keep developing drugs, whether we go into a recession or not. Again, the demand is not quite cyclical. There are, of course, some exceptions, and the main exceptions that come to my mind are hotels and offices, maybe even malls, but these represents less than 10% of the REIT sector. So for the most part, REITs own recession-resistant properties that will keep delivering consistent and predictable cash flow, whether we go into a mild recession or not. That was my first point. Now we go to our second point, which is that REIT valuations are already heavily discounted. They've crashed by about 30% over the past 2 years, even as their cash flows grew by another 10%, give or take. And so what this means is that their valuation multiples have crashed by about 40%, in some cases closer to 50 or even 60%. And so, yes, quite often when we go into recession, we see stocks and REITs crash, but REITs have already crashed. And so I think that this affords significant margin of safety because REIT valuations are today the lowest since the great financial crisis. I'll put a chart on the screen that will show you this. And so there is significant margin of safety already built in here. Since valuations are exceptionally low already, can they drop even lower? Perhaps they could, but I think that it's more likely that we see a recovery if we go into a recession, because the main reason why valuations are so low today is the recent surge in interest rates, but a recession would cancel that, because typically what happens when we go into a recession, we see interest rates drop significantly as the Fed steps in to stimulate the economy. Already today, even before we hit the recession, they are talking about now cutting rates. The Fed Watch tool is predicting roughly 100 basis point rate cuts within a year from now. If we go into a recession, the rate cuts could be even more significant and even quicker. And again, since the surge in interest rates would cause REIT valuation to crash, it seems logical that the decline in interest rates would cause the opposite. It would lead to a recovery in the REIT sector. And so to recap my reasoning here, most REITs have recession-resistant businesses, the valuations are ultra-low already, and interest rates are likely to be cut if we go into recession, which would be a very strong catalyst for the REIT sector. A final point I want to make here is that the investment firm Cohen & Steers actually did a study on this topic a few years ago, and they found out that REITs strongly outperform in late cycles, which is probably what we're in today, as well as in recessions with about 2 times less downside risk than the regular stock market, such as the S&P 500. I'll put a table on the screen when you'll see the results of their study here. Basically, they went through all the past recessions over the past few decades, and they came up with the average results of REITs versus stocks. And yeah, you see there that REITs outperform, and this makes sense again because REITs have very defensive business models, their valuations are typically quite reasonable, they use little leverage, and I think that today specifically, I think that they should perform even better in a recession again because leverage is at an all-time low, valuations are ultra low, and they're low because of the surge in interest rates, and a recession should cancel this factor that's causing REITs to be discounted, and therefore logically REITs should actually benefit from a recession. It will of course then depend from one REIT to another. If we're talking about a highly leveraged hotel REIT, then yeah, obviously that REIT may suffer if we go into a recession and suddenly there's way less people visiting its properties. But for your typical REIT, like a cell tower REIT, like a Crown Castle, or a net lease REIT like Realty Income, an industrial REIT like Prologis, I think that those REITs will benefit from a recession because of this unique context that we are in. Now, if you have any questions about the REIT sector, please let me know in the comment section below. And then I want to remind you that we're still offering a 2-week free trial to our REIT newsletter, High Yield Landlord. There you will gain immediate access to my entire real money REIT portfolio, all my trade alerts in real time. And we are also offering a course to REIT investing. As part of this subscription, you will get immediate access to it with your 2-week free trial. So if you want to join in just to take the course and learn about REIT investing, that's perfectly fine with me. You cancel within the first 14 days, you won't be charged anything. And if you think that this is valuable and want to stick around with us and invest in REITs for the long run, then you'll also get a $100 discount as part of the 4th of July. Finally, please click the like button, subscribe to the channel. That helps me a lot. Thank you so much and see you at my next one. Bye-bye.